Okay, welcome everybody. Thanks for joining us today. My name is Clay Malcolm here at Advanta IRA, and I'm delighted to be joined today by Derrick Barker and Sandate from Nectar, and we're going to be talking about short-term rentals as an investment class and different ways to participate in that market. And it seems like a very timely thing because I get lots of calls about the possibility of combining short-term rental returns with IRA tax advantages. So delighted to have them today. We're going to do a little bit about self-directed IRAs and a little bit about all the possibilities of investing in real estate with your self-directed IRA. And then I'll probably at about 10, 15 minutes in, we'll turn it over to Derrick and Andres, and they're going to take the bulk of the time to again, talk about this asset class, potential ways that you might be able to participate in it. If you have questions, please do type them into your questions box in the console, and we'll answer those at the end. And go ahead and type them in as they occur to you. The presentation might cover them, but maybe not. And Derrick and Andres were gracious enough to allow us to ask a few questions at the end, so we'll be doing that as well. So without further ado, let's go ahead and talk a little bit about self-directed IRAs and how they participate with real estate. One of the things that I do want to mention is that, of course, all the information that I'm going to give you today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or any particular investment vendor. Our role in the equation is actually a very neutral one. Our job is to document the activity of the account so that the IRS understands that the account is invested in this particular alternative asset that you've chosen, and therefore gets to keep the tax benefits. So we listen to you in terms of what you want to invest in, and we help you to assemble the documentation that's appropriate for that. And of course, we do the appropriate IRS filings and that kind of thing as well. So our job is really to be a facilitator of the investment for your IRA. And any investment that you're considering for your IRA or for your personal finances for that matter, we certainly encourage you to do your due diligence and use your professional and professional team, as well as your family members or whoever it is that you get advice from. Whether so it could be an attorney, a CPA, financial advisor, whoever your financial team is, and the rest of your team. Please do utilize their services and their help anytime that you're considering a particular investment or doing due diligence on any of the entities, including Advanta IRA, that would be participating in an investment sequence. One of the things that is part and parcel to the idea that we are neutral and really just kind of documenting the activity of the account is that due diligence does fall on the account holder. So you're going to actually be choosing the investments, negotiating the terms, and so that process is actually in your house, so to speak, as a participant in your IRA's investment strategy. So again, because we don't sell any assets or give any advice, that becomes your responsibility, and we encourage you to do the appropriate due diligence to your comfort level. At Advanta IRA, we were built for customer service, and again, the idea of documenting these accounts, and we specialize in the bookkeeping and the administration for accounts that invest in alternative or private assets. And real estate obviously is a very popular asset class for us. We've been around for almost 20 years. We are a medium-sized company in the space, so we do the administration for about $2 billion worth of IRA money or tax advantage money. And we're built for customer service. So every account holder gets a two-person team. It's myself or one of my colleagues as the education and onboarding person, and then a back office account manager that is really your go-to person for some of the nuts and bolts things like investment paperwork, and if you have any questions about what's going on in your online portal, things like that. So you have our contact information, our email, and our phone number directly, so you always know who to turn to if you need any information or need to ask any questions. So we're really here to, again, support you in your investment strategy. And when we're talking about self-directed IRAs, and specifically the offering that Advanta IRA has, remember that self-directed IRAs, that term self-directed is not it's not an account type. It's not a legal distinction. It's really a descriptive term saying that the account holder is going to have a choice in terms of the assets that their account money is going to be invested. At a bank or brokerage house, a self-directed IRA might mean that you get a choice between several mutual funds or some stocks and ETFs and things like that. So that's the way that their offering is structured. At Advanta IRA, of course, we specialize in these alternative or private assets. And so it's a combination of the tax advantages of the account type with the returns that you can get in a private investment. But do remember that the accounts themselves, they stay the same. They're the ones that you're already familiar with. So traditional IRA, Roth IRA, those tax advantages stay the same. The contribution rules stay the same. The distribution rules stay the same. Everything is exactly the same, except that instead of that money, once it's in the account, purchasing a stock or a mutual fund, it's going to purchase a piece of property or make a loan or a part of a syndication or a part of a private entity that is then going out and investing. So the asset is going to change, but the rules for the account really don't. I do want to point out that we also do self-directed HSAs, health savings accounts. They're becoming much more prevalent these days. We handle some employer accounts like a SEP IRA and a Simple. We do Coverdell education savings accounts. We also do offer a solo 401k plan that allows you to invest in alternative assets. But all of these accounts, you may already have some of them, but I would say that the most common thing is that you have an old 401k or a 403b, 401a, thrift savings plan, some kind of retirement plan at an employer where you're no longer engaged. And that plan is automatically mobile, meaning that it can be rolled over without tax and without penalty into a self-directed IRA. And the reason that you might want to do that is, of course, having a self-directed IRA at Advanta means that you can access alternative assets, whereas at the retirement plan where the money is now, you might be restricted, and usually are, to publicly traded securities. So your ability to position that money where you want to in order to invest in the asset class that you want to is there for you, and I'm happy to answer any questions about that either during the webinar today or at any time in the future. So when we talk about self-directed IRAs, especially at Advanta, and again, we're kind of an alternative asset provider. What we're doing is combining the tax advantages of the account type with these private alternative hard assets that we're talking about. And those permissible assets are myriad, right? So real estate is a big one. You can do residential, commercial, it could be raw land, it could be agriculture, all kinds of things. Private lending or debt instruments is very a popular asset class as well. We'll be talking a little bit about that today as well. Private equity, private placements is meaning, of course, that your IRA invests in a private entity that is out either doing business or investing in a particular asset class. Often that's real estate. Real estate syndications are a prime example of that. Precious metals, so that's gold, silver, platinum, and palladium. Obviously, gold's been on a little bit of a run lately, so your ability for your IRA to invest and buy physical precious metals exists. Cryptocurrency obviously is becoming much more popular these days. So your IRA, and we've actually stayed the course and tried to make sure that our cryptocurrency methods for investment are inexpensive and also give you a range of ability. So please do ask us about that. But I'll just say that, anything you know how to make money at outside your IRA, typically you can make money at inside your IRA as long as you take the time to set it up properly. And going back to the account types that we talked about before in terms of what you're going to invest with your self-directed IRA, do keep in mind that you're in control of that as well in terms of how the allocation works. So it is very common for somebody to have an IRA with us that invests in alternative assets as well as an IRA at a bank or brokerage house for whatever publicly traded securities you want to be in. You can have as many IRAs operating simultaneously as you want. And again, positioning the money at a particular custodian in order to invest in a particular asset class is really that's the pairing that you're looking to create. And let's talk just a little bit about real estate here, and then in the not too distant future, I'm going to turn it over to Derrick and Andres. But we talk about the fact that real estate has a lot of different arenas where you can invest, and it also has some different ownership structures as well. So an IRA can be a title holder and 100% owner of a piece of real estate. whether that's a single family rental or a storage building or apartments or warehouse, any of that kind of thing. An IRA can use debt to extend its buying power. So an IRA doesn't have to have the full purchase price in order to buy a piece of property. It can take out a loan. So that's a remarkable thing that the IRS lets us do. And if the numbers work out on a particular deal, sometimes debt leverage is a way to create earnings for your IRA. An IRA can be partners with other investors, and those other investors could be other people, other entities like LLCs or C corporations. The other partners could be other IRAs even. So there's lots of ways to partner your IRA. So again, if you don't have the full purchase price of an asset, that doesn't mean that you're necessarily out of luck. Think about other ways to participate. I mentioned earlier that an IRA can be a lender, and that can be either a direct loan, so the IRA originates the loan, or an IRA can buy fractional notes, things like that. So any of the debt instruments and things like that that are associated with real estate, those are possible investments for your IRA. And then the last one there is the syndication idea that I talked about before, the private entity. So an IRA typically buys into an LLC. It doesn't have to be an LLC, but that's certainly the most common one. Or another entity that is out there then investing in real estate or doing some other type of business that can generate some returns for your IRA. So do understand that your IRA can be an investor in a lot of different actual properties or property types, as well as have some different ownership structures. And all these things are things that you can tailor to your particular investment needs and strategies. And I took a little bit of just a short minute to talk about short-term rentals in an IRA, a lot because I do get a lot of questions about how does that work. And I'll just say that, your IRA is allowed to invest in a very similar manner to your personal funds, with the exception of there are some disqualified person rules and some prohibited transactions. But those things, again, if you're not investing with certain family members and things like that, that's usually not in the scope. So the things that you're looking at when you're talking about short-term rentals are usually these factors. So one is, an IRA is like any other investor, so it does need to follow the rules and the regulations that are set forth by both the federal government as well as the local jurisdictions. And I certainly hear a lot of stories from folks who are contemplating this type of investment, talking about local jurisdictions and very particular rules that exist in their town or their state or things like that. So do understand that you need to be aware of how an investor that is running a short-term rental needs to interact with the local jurisdictions. Property management is a big one, simply because the IRS does have some rules about I say that you as the account holder, your participation in the property management. Now, you are obviously going to be the decision maker and the strategy maker for your IRA, but the IRS really doesn't want you to either be running a property management business that is getting paid by your IRA, and it actually doesn't want you actually out there doing the work yourself, you as the account holder, and certain other disqualified persons. They consider that to be a contribution. They don't know how to tax it, and it's not something that they want to deal with, so they prohibit it. So thinking about how you're going to set up your property management, because of course short-term rentals typically have a more intense management cycle, that can be something that you want to look into it ahead of time and think about. And certainly if you're looking for something that's more passive, you might be able to do that in another way. And in fact, Derrick and Andres are going to talk about that today. It's one of the reasons why I thought this was such a timely webinar, is because they're allowing a participation or facilitating a participation in short-term rentals that would be much more passive than this kind of direct approach. Now, all that being said, I do definitely see folks who have their IRAs invest in property, do short-term rentals, but a lot of times they have an eye toward maybe wanting to use that property at some point. Now, while your IRA owns it, you personally are not allowed to take use of that property, so it's out of bounds for the time being. But if at some point the investment has become someplace that you want to then transition to actually using, you can actually take an in-kind distribution of your IRA-owned asset. meaning you basically just change the titling from ownership by your IRA to ownership by you personally. Now, if it's in a traditional IRA, there will be a tax event associated with that. If it's in a Roth, there won't be. So again, combination of the rules of the account type with the asset class. But do understand that there's a number of possibilities out there for you, and looking into those ahead of time and devising a strategy that meets your needs is really kind of the key match that you're looking for. I'm just going to point out a couple quick things here, and then I'm going to bring on Andres and Derrick. So this educational webinar, as well as some of our other tools like our blog, our YouTube channel, and things like that, and live events when we can do them, is certainly a way that we like to participate with the investment community. So do feel free to avail yourself of these resources, and I'm happy to be a resource on anything that we talk about today, or any kind of IRA investment strategy they might have in mind. We could talk about account types or the way that the IRA can invest in a particular asset class. I'm happy to run down a scenario with you at your convenience. And a lot of people think, well, gosh, this is going to be kind of difficult to set up a self-directed IRA that does alternatives, and it's really not. It's very quick. You send in an application. Generally, that takes 10 or 15 minutes to fill out. We get the account open in a day. We fund that account or get some money into it via transfer from another IRA, rollover from an old 401k or other retirement account, and or contributions. So you now have an account that can invest in alternatives. You put some money into it, and then you're out looking for the investments that you want that money to make. And we help you document that activity again so that you get to keep the tax benefits. So that's really our role in the equation. And like I said, today, our main goal is going to be to talk about short-term rentals, that marketplace, and specifically kind of what Andres and Derrick have going on at Nectar. And so I'm delighted to be able to introduce them here. So Derrick Barker and Andres Sandate, they're going to turn on their cameras. Fellas, are you both still there?
We're here, Clay. Thank you.
All right, and I'm going to see if we can get the Derrick. Do you have the screen to take over there? So Derrick, I see you muted. If you can unmute yourself, that'd be great.
There we go. Hey, I'm here. That was more difficult than I thought. It was asking me to share my screen. I couldn't unmute while I was doing that, so my apologies. I figured it out.
No worries at all.
And here we go. So, nice to meet you all. Thanks for the time.
And Derrick, did you want to go ahead and accept the screen sharing capability there?
Yes, let me try to do that. Originally, that was what was stopping me from being able to, come on mute. So let me. I don't have it anymore, but give me a second to see if I can get it back.
All right. There we go.
Is it working now?
Yes, sir, it is.
We can see it.
Great. Sorry for the technical difficulties there.
All right, everybody. Well, Andres and Derrick, I'm going to let you guys take over, and thanks a lot for joining us and being here today.
Thanks a ton. We can start with kind of quick introductions, and then we'll try to hit on a few topics. So why don't we start with quick introductions? Andres, you mind giving them a quick introduction of yourself, and then I'll go.
Yeah, sure. I want to first tell Clay, thank you for having us on to talk about short-term rental and just provide some education and insight. Again, we appreciate the opportunity. My name is Andres Sandate. I'm head of capital markets here at Nectar. Joining me today is Derrick Barker, our co-founder and CEO. So we're going to take you through 20 or 30 minutes of kind of a master class, if you will, and sort of opportunities in the short-term rental space, passive, semi-passive, active, where the short-term rental market is today in terms of its life cycle, and more specifically, where we think, investors who want to utilize their IRA to participate in the asset class have different entry points. Of course, we'll talk a little bit about, our view, our biased view on kind of where we think the best risk-adjusted return opportunities are, but we definitely will start with kind of an industry overview, then take you through some different options that you can participate, and then finally hit on what specifically we're doing and building at Nectar. So with that, I'll turn it over to Derrick. We appreciate the chance to be in front of you, and definitely encourage you to submit your questions to Clay, and we'll address them all at the end.
Awesome. Thanks, Andres. And I'll give a quick intro and then kind of dive right in. So yes, my name is Derrick Barker. I'm the CEO of Nectar. But my background is in the real estate space. So I started buying real estate really early on in my late teens, and then built a pretty big portfolio, eventually becoming a turnaround specialist after the financial crisis. So taking blighted apartments and renovating them, and taking them from the worst properties in the neighborhood to the best properties in the neighborhood. And I did $400 million with that deal volume, almost 5,000 units. And so that's where, and within that, we had a short-term rental portfolio, 125 unit short-term rental portfolio. So that's kind of a lot of where my background is. And then I started Nectar about 2 years ago, or just under 2 years ago. And we have, and we'll get into more of what Nectar does and what the opportunity set there is at the end of this call. But to start out, as Andres said, I like to start a little bit about the short-term rental market and why it's interesting for investors. So just to start at ground zero, what is a short-term rental? And it's where property owners can rent out their space, a furnished space, move-in ready space, for some short-term period, from 1 day to 6 months. But these are typically rented to travelers who are looking for a furnished home or apartment instead of a hotel, kind of as an alternate to a hotel. In the past year, in 2020, there was a huge spike in the popularity of short-term rentals as remote workers, business travelers, and people going on vacation had temporary housing needs and needed temporary accommodations for varied reasons. And this alternative to hotels is the fastest growing part of the hospitality industry today, and it has been for several years. So as I mentioned, demand took a big leg up in 2020, going up over 100% in some markets, like secondary cities and small domestic markets, but up over almost 50% kind of domestically. And it is expected to go up another 20%. So demand is expected to increase by another 20% this year, according to AirDNA, which is a data company that tracks the short-term rental marketplace. And that's been, as a heads up, that has been revised downward since the onset of, the current geopolitical risks that I'm sure you've heard about. So some other facts about what's going on in this market. The biggest player in the short-term rental market is Airbnb. And they have over 4 million hosts here in the US that are offering these short-term rental accommodations. But there's also VRBO, there's Booking.com, there's a long tail of many operators who provide a platform to allow people to offer their spaces to travelers. And this, the short-term rental space has been, quoted as being the biggest change in the travel industry has undertaken since the advent of commercial flight. So it is a big change, a big thing going on in the industry. And because of that, it's immature. But in terms of the institutional financing capabilities from a debt and equity perspective. Despite that, though, and because some of the novelty, your owners who have and investors who are in this market can generate really high margins. So 15% or more cash-on-cash returns are typical. And even higher returns are possible. We've seen 50% type cash-on-cash returns, but that is an outlier. But it's much higher than a traditional rental would be. And therefore, the industry, there are more and more people that are coming into this industry to professionalize and institutionalize it. At one point, the typical person providing a short-term rental would be a mom and pop operator who's renting out a guest home or a second home or a guest bedroom. even. But now, and that was the most of the short-term rental industry, and that's how a lot of people still think about it. But today, because of the high returns, the fastest growing part of the short-term rental market is professional operators and institutional operators who are building hospitality companies that provide hotel quality service and unique experiences to their guests. And as more and more institutional quality providers arise, what they're seeing is there are just very few, if any, like institutional financing partners for them to help accelerate the institutionalization of this asset class. So that's a little bit about the market. I guess now a question is, so how can you utilize your IRA to participate in the short-term rental market? And there are a few ways. There's the active and passive. And I just, would you like to take some of this, or kind of talking through?
Yeah, I'll hop in and just kind of highlight some different options that investors have. So, Clay talked about different things that you could do with the IRA, and so this probably comes as no surprise to many of you who are experienced investors. But if you looked at the spectrum of ways in which you could participate in the short-term rental economy, I think on one end you have a fully passive approach, and that could be something like investing in, now that Airbnb is a publicly traded company as of 2020, you can buy that company on the NASDAQ and own that company in your IRA directly. So you'd get exposure to more of a platform, because they make money from being a marketplace effectively, from hosts who are setting up properties, and then obviously guests or travelers who are booking properties. So that would be kind of a fully passive approach. On the other end of the spectrum, an active approach would be, as Clay talked about in his remarks, setting up your own property and becoming a host. And so you could use your IRA to go out and acquire a property. There are certain things that you can't do, like live in the property part-time and rent it out part-time, or run it as a short-term rental. But assuming you were to follow the rules and regulations with respect to the IRA, you could set up and host a property. I think that on the active side, one of the things that we've seen a lot of from our conversations is a lot of folks who are not currently in the short-term rental space. They see the potential for returns. They see the friends or family or people that they know, who maybe have set up 1, 2, or 3 Airbnbs, and they're making money. And so they start to get curious, and they start doing research, and they start investigating, what about setting up our own? And I think a lot of those conversations end up coming back to, the entry point for getting your own property. It's expensive. As Derrick said, you're now competing with, millions of other hosts in sort of trying to find the right property, having to host it. And now you're running a hospitality business, so you've got all sorts of new considerations, right? So it's a very active, maintenance, cleaning, booking, insurance, and on and on and on. And Derrick can speak to that experience specifically, having managed with his partner 125 of these. But we kind of look at it along that continuum. I think that there are other sort of semi-passive ways, semi-active ways that you can get involved as well. What we're doing at Nectar is we're starting to see this bifurcation and this evolution of the industry that Derrick alluded to around the institutionalization of the space. What is not kept up as far as where the need is in the availability of capital, the availability for hosts who want to grow, who are generating 15%, margins, who have, professional, stabilized businesses. There's not institutional capital available to them for them to grow their business. And so we'll talk a little bit about that, but really there are a variety of different ways that you can participate, from, like I said, the passive, owning, say, a stock like Airbnb, to all the way on the other end, setting up and getting into hosting. There's other probably I would say, smaller ways that you could participate in the short-term rental space through the IRA, like investing in like other professional services that are being, now provided to the Airbnb economy. I think those are a little harder because it's really a mom and pop, highly localized market. But that's kind of how we see the market. So I'll turn it back over to Derrick, and maybe he can articulate where this bifurcation, why it's underway, and kind of what it means for investors who are looking to participate in this, in this particular space.
Yeah, so thanks, Andres. So yeah, so that does kind of lead us into like kind of Nectar and kind of where we sit and how we see things. So as Andres mentioned, there's a bifurcation where there's some more professionalization of the Airbnb operators. And as a real estate investor and real estate entrepreneur, what I saw is a lot of my investors are mostly interested in cash flow. They're interested. We generated great returns, but they're very interested in the cash flow portion, of real estate investing. And what Nectar does is take that desire to get a high stabilized cash flow or income stream, and in order to do that, and allow investors to participate just in the income stream coming off of these properties, because these short-term rentals just have such, they're making so much cash flow relative to their asset value. So what we do at Nectar is we work with these professional Airbnb operators who have 5, 6, 7 properties, who've been operating a hospitality business effectively, and we allow them to sell a portion of their net income by allowing them to enter into a cash flow assignment agreement. And we get several of these cash flow assignment agreements, and we package them together into an investment vehicle, and allow investors to purchase a fractional share of this investment vehicle that has dozens of experienced professional short-term rental income streams. So you're able to buy purely an income stream. So you're not buying the underlying asset, and so you don't get kind of the upside appreciation from that perspective, but you do get stabilized cash flow and distribution starting immediately upon investment. And what we do is we buy income streams at a discount. So you're able to get low double digit 12, 13% type yields. And because it's like, I would think of it as straight line amortization, that's like a principal and interest payment every month. Your monthly distribution ends up being in the 40% range. So you're able to get a 40% monthly distribution, with a lot of it being return of capital, but then a roughly, let's say, 12, 13% type yield from that. And what a lot of investors do is they reinvest it monthly to allow the power of compound interest to really work in their favor, and that ends up generating quite a high annualized return over the course of, say, a long term, like a 10-year period or the like. I'll dive into the slides really quickly and talk a little bit more about kind of our product as a passive income-based investment. So a new way to invest in real estate, buying real estate income streams as opposed to the underlying assets. So as an overview, we are in a marketplace that creates that creates investment opportunities, securities that are income stream securities. We focus on stabilized short-term rental assets, but we also look at apartment assets and other asset types. But our current offerings are mostly short-term rentals, but only for experienced short-term rental operators. We're starting there mostly because these assets are very low leverage, because banks and lenders don't understand the asset class. So typically they're at 60, 65% leverage, as opposed to apartments and single family that'll be in 80% leverage in some cases, which ultimately reduces the risk for us. Our team has a ton of experience in the finance and real estate space, and in credit and in structuring as well. Let's see. The founders or myself, I've talked a little bit about my background. Our partner, Brittany, who ran our short-term rental business and built a 125-unit portfolio. Before that, we had corporate jobs at Goldman Sachs, and we ran real estate companies. And Brittany was ran Hollister tops, so at Abercrombie and Fitch before she got into the short-term rental space. So she was a Airbnb entrepreneur kind of originally after her job as a corporate executive. This is talking a little bit about why we have a future. We're focused on making advances to short-term rental operators, but mostly it's a big opportunity set. These people have a ton of cash flow, and they're largely ignored by the real estate capital markets currently. And these are who we're typically targeting. So we're not targeting the mom and pop operators that, as I mentioned before. They're property owners with 5 or more cash flowing properties that currently have the 60 or max 70% leverage in their mortgage. They have third-party professional operations or professional management already, or they're owner operators that are also professional and doing it full time. And we also work and partner with larger property managers who have 200 or more units as a way to identify really high quality cash flows. Our typical deal size is about $200,000. So that's our typical investment, but we'll pool 10 or 20 of these $200,000 advances, let's say, into one SPV that we allow investors to buy a fractional share of. And the difference between us and a traditional mortgage is, we're providing cash flow based financing. We use technology to underwrite quickly, have a completely automated process. It's completely automated, say 80% automated. We get all the documentation and everything in the standard form, and then we have our team of experienced underwriters to review every transaction before you make an advance. We're able to do it quickly. It's cash flow based, and operators, the owners, end up continuing their ownership of the property. And they love us because we don't affect their debt to income ratio. We allow them to keep ownership of the property without taking on additional, without mortgaging and getting higher leverage from a mortgage perspective. The most important thing about this is when you're in this market, you really have to look and underwrite in a detailed way. And we have 9 kind of criteria that we use to underwrite. That to go deep into how we look at these things, and and if whether you're investing yourself or you're providing loans, or however you like to invest and participate in this place, I would encourage you to have a deep and sophisticated underwriting methodology, because there's a lot, as the market bifurcates and there's professional operators and kind of smaller operators, the underwriting becomes more and more important. Because there's not, at one point anybody who put a place up was able to get a ton of traffic. Now the traveler is more discerning, and so the ability to maintain a high quality cash flow and a high quality income stream for yourself, or if you're looking to invest with someone else, it's just more challenging now because there's more competition from people who are actually professional, and that's something that we take seriously. With our structure, the operators take the downside risk. So instead of, so if an operator is making, if we underwrite them and say on average you're going to make about $25,000 a month, or $20,000 a month, we will only take 60 or 65% of that cash flow that you're making. So if you're making, let's say for easy numbers, $10,000 a month, we'll say, look, we'll give you an advance of and you have to pay us $6,000 of your $10,000 a month income stream. So if you have a month where you make $8,000, it doesn't impact our investment at all. It's the operator, the person who owns the property, takes the downside, the initial 35 to 50 points of downside risk on their net cash flow, in order to insulate our investors for their return of their principal and their interest. And from a principal perspective, even if because the returns are decently high, I mean, you're talking about a 35% loan to value is how you could think about this. So what happens if an operator is underperforming? So firstly, if we have the right, Nectar, to replace any underperforming management company and assign a new best-in-class manager. We have great relationships with tons of operators in every market that we work in. And if there's one property that's underperforming, then we have the right, when we provide our financing, to change out that manager if there's underperformance. We can also extend the term of our agreement. So if we enter into a cash flow assignment agreement where the operator has to pay us $6,000 a month, they're making $10,000. Say they have, it's a sustained downturn, and they went from making $10,000 a month for the past 2 years to now making, $5,000 a month. We can the first line of defense is we can just say, hey, it might be it might be a seasonal downturn. We'll add that $1,000 to next month. And when you have like an up season, like during the summertime, you can pay us back. But if it extends longer and we get to the end of our, say, 3-year term and you still owe us some principal balance, then we can extend indefinitely while we recoup that amount. We can also, if you sell the property, our note converts to recourse, so we can go after the proceeds of the sale through the property owning entity and any sponsors owning 20% or more. And if there's any other bad boy type, activity, it converts into personal recourse. The property owning entity and all sponsors who own 20% or more. This is a little bit more, kind of detail on our investment process, which it might not be appropriate to go into on this call. And we're a tech-enabled service that, we have lots of partners and have our own internal technology team to provide both high-quality experience to the Airbnb short-term rental operators and to investors who invest alongside us into this asset class, these income streams. And in general, we have several different methods, and we're in this space all the time. So we have several different methods to help us to find high quality operators in order to have a high quality underlying credit risk. And I think that's it in terms of kind of what I have here prepared. I'd love to answer, take this time to answer any questions that might be up there about the short-term rental space in general, the real estate space in general, or about our offering, to the extent that that's interesting.
Hey, Clay.
Great. Thank you so much, Derrick. And Andres, did you have some comments before we shift into questions?
Yeah, thank you, Derrick, for giving an overview. There's a lot to cover, and we definitely want to take questions from the folks on the call, and we appreciate you sticking with us. I get a chance to talk with investors throughout the day, and one of the consistent themes, and this is no surprise to many of you, then it's been this way for some time, is how can I generate consistent, steady income? What are different investment options out there that can do that? I mean, of course, there's always, growth that's consideration, but for a lot of investors, particularly those who are entering a different phase in life, maybe they're retiring, or maybe they are looking to start to travel, and they're looking for ways that they can maintain that certain standard of living. Income becomes a big focus. And so when we were thinking about this opportunity, there was really 3 things that drew the company to say, yeah, we could go out and assemble a big giant portfolio of Airbnbs and be a super host, like some of these platforms that Derrick alluded to that have 1,000, Airbnb properties and compete with hotels. But there's also the credit side of the business, right? Somebody has to finance these operators. Somebody has to provide them with the capital. And that, while maybe not as flashy of a business, it doesn't have maybe the retail exposure of a hospitality brand. is actually a really good business for those of you that, that have studied asset management companies and banks and insurance companies. And so we looked at it and said, there's not been that many times in history when you have a category that's growing at 15% a year, where they're generating double digit, and Derrick alluded to, while maybe an outlier, 40 to 50%, type returns, certainly 15% consistent returns. And there's nobody else providing institutional capital. So you have this huge gap in the market. And those are the three compelling reasons why this organization exists, and why in a very, very short period of time, literally 60 days, we built a wait list of cash flow sellers. So these are hosts with stabilized Airbnbs, VRBOs, they're generating cash flow hand over fist, and they're voluntarily saying, we want to sell you our cash flow in exchange for growth capital, because they see an opportunity to grow their portfolio, and they want to do that without an equity partner that dilutes them, or they're just simply getting turned away by their bank, or they don't want to take on a hard money loan. And so this is a very, very unique time, where you have this set of forces, where you have operators, and we built a wait list in 60 days of close to $25 million of quality, consistent cash flow, which we fully intend to convert to passive income for investors, and Derrick alluded to it, targeting kind of a 12% annualized yield paid immediately. So with that, we'll turn it back over to you, Clay, and take some questions in the last 10 minutes.
Well, thanks, Andres, and thanks, Derrick. I really appreciate the overview and the fact that you took us through different ways to participate in this asset class. And one of the questions that's on here, I think, talks to a little bit about what you were just mentioning, Andres, and also something that we all talked about when we're thinking about the idea for the webinar. So I'll start by saying this. So what's the reaction of it? If what I'm hearing is that what Nectar has put together is trying to provide capital for short-term rental operations that want to expand. Is that a fair characterization?
Yes, they're growth-minded. They want to grow. Yep.
And then what's been the reaction of them for? Goodness gracious, what's going on my screen? And what's been the reaction for them to be able to access capital via a cash flow return rather than giving up equity in their properties? Do you have to talk them into it? Are they liking it? How's the reaction for that going?
Ultimately, people they like it. It allows them to expand their portfolio, and a lot of these operators are looking to, own property, and and that's their part. And they see that I can own 10 properties, and then save up money and then buy another, or maybe I can have 10 properties and I can sell a portion of my cash on those 10 and buy 3 more, and then have 13 properties. And that's kind of how they're thinking about it. Whereas, net, they'll probably make a similar amount, maybe a little bit less, but they have more properties. And after a term, the income stream that they sold, they sold 3 years worth of cash flow. 3 years from now, they get the benefit of this bigger portfolio.
Gotcha. And so I'm just going to read the question.
Clay, the other thing is that they get to keep their upside. I mean, for way, way too long, real estate entrepreneurs, many of whom are probably on this call, have had to go out and find an equity partner, after they get their debt to finance their deals, right? So, and what is that equity partner taking? They're typically taking somewhere between, 80%, maybe 50% over a 15 to 20% return, right? So these operators also like it because they get it. They have gotten past we're going to survive and make it mode. They now are in we want to press on the gas mode, and we need the capital to do it. And so if you can say to them, we are going to allow you to keep your upside, which is good for us and our investors because they know how to run these properties. So why would we want to go replace them unless they underperform? So they continue to keep the upside. They got to be motivated to get up and work every day, right? And we're getting paid just after the mortgage, the utilities, the taxes, and the turnover costs. So we're kind of next in line as far as the investor. So.
Got it. So the question that prompted my paraphrase question, I probably should have just read it, but why would an owner want to give up 60% of their cash flow? What's the advantage? And I think I've already heard the answer, but you want to give an encapsulated recap of that?
Yeah, they give up 60% of their cash flow for a 3-year term, and they use that cash that that they get today to buy another property that they own for they own forever, and and then after 3 years, they have the benefit of 100% of the cash flow from both properties.
So it's certainly fair to say that what you guys have been dealing with or working with over the creation of Nectar is an investment from the investor's part. Do you want to try to have an operator like this bring on investment capital via equity or via cash flow? That's really the dividing point that you guys have focused on. Yeah. Okay. Okay. There's questions about minimums and maximum investment amounts. So you guys want to tackle that? The fund that you have, what's the status of that for somebody who might be interested in that?
Yeah, sure. I'll jump on that real quick. So we set up a 506c offering, so it's available for accredited investors. Obviously, we can accept qualified dollars, which is why we're delighted to be here on the Advanta call. We have a $25,000 minimum. Our offering is going to be available for a little under 90 days. And we just launched it. We've already taken in some capital. We've already deployed some capital. So yeah, I mean, now is the proverbial time. We've got a data room, Clay, so we can make that available to anybody who's interested.
Got it. There's also a question here about a more direct IRA investment in short-term rentals. So I want to address that for a moment too. So yes, an IRA can purchase an investment property that they are going to utilize or engage in short-term rentals. Yes, the account manager, the account holder can manage the property in as much as they can make the strategy decisions and things like that. They can't formally manage the property in as much as an IRA holder's business. If they do property management as a business, your IRA would not be allowed to engage your personal company to do that management. So I would say that one of the things that we often talk about in terms of IRA investors and their ability to participate in real estate is you can do brain power. You can't do a lot of physical power, so no sweat equity. And then also you have to be aware of the prohibited transaction of providing services for your IRA. So the IRA holder and certain disqualified persons are not supposed to provide services for their IRA investment. And the case law doesn't delineate that, chapter and verse or any of that kind of thing. So there are some cases that have been adjudicated that might help your, paint the boundaries of that. But like I say, usually it's the IRA holder making decisions, hiring a property management or a property manager or different vendors that they can use through time. But usually it is a little bit of arm's length and pulled back by that. And yes, an IRA can use debt, can borrow money in order to purchase a property. When you do use IRA, when your IRA does use debt, you do want to look into UBIT, unrelated business income tax. And UBIT would be particularly important for a short-term rental operation because it may be viewed as a business rather than even just a passive piece of real estate. So UBIT is something that you would want to look into as well. So all the things that the questioner is asking about, can you use debt? Can you manage it yourself? And things like that. Yes, you can. and there are things to consider. And our YouTube channel has items on all this stuff, as well as you can always call me and we can talk it through. So all of those things are available. And then this next question is for you guys, and I actually had somebody ask me this question before the webinar, so I'm glad that somebody also brought it up here. And the question is really about local laws and things like that. Is there a geographical bias or a geographical rule that somebody should be thinking about? Do the local rules and laws and things like that affect the returns on the investments? Can you kind of weigh in on that?
Yeah, absolutely. I'd say, like, there are two kind of ways I look at this. You want to be in a place that has laws in place. I think that, like, if you just have if you're looking at a blank slate and you can choose, I say the least risky is go someplace that has laws in place that's already taxing the short-term rental income. You might look like you make less money, but you know what you're getting going in. It's hard to change the laws once they exist. And once the municipality is generating tax revenue, they're not going to want to give it up. So like that's like the safest. After that, I would say, places that are just like places that are like vacation destination type places where they're not going to get rid of your ability to do short-term rentals in I don't know, Myrtle Beach or some of these places. So I say, like, that I go to those places and looking where, again, are they already taxing? If they're taxing the short-term rental income, then we think of that as decently safe. Places that are unregulated, that's, to me, you're risking that it's going to happen at some point during your tenure while you own the property. It might never happen in some municipalities. A lot of these municipalities they're happy to have the additional traffic and the additional taxes and economic drivers that come with it. Some places they're going to say, oh, well, this is crowding out affordable housing, and that's just coming down the pipeline, and you don't want to get caught off guard. So I say, like, if you look for, and what we do is we look for places that already just have laws in the books.
So that's part and parcel of what you're saying about this being a relatively new industry, and not every place is caught up to it, and so there's some variability. And it sounds like what you're looking for, and what you're saying that an investor might look for, is a place that's already kind of acclimated to this business model.
Yes.
Okay.
A place,
we saw after the I was going to say, when the pandemic hit, you saw a lot of people leaving cities and saying, hey, we're going to go decamp to to upstate New York. Well, what happened is so many people had that brilliant idea of buying a home in upstate New York along the Hudson that all these small towns were inundated, with people. And then boom, overnight, there was laws on, short-term rentals that, didn't exist 6 months before. So we try to look at it, and we're more biased towards operators and properties where there's already laws on the books.
Okay. There's a couple of investor questions. So somebody wanted to clarify, does an investor for the fund need to be accredited?
Yes.
Yes, at this time they do.
Okay. And what is the term of the investment is the next question.
So it's about a 3 to 4 year term, Clay. And I say about because our typical term of the cash advances is 36 months. So the structure, without getting too arcane into the detail, is we have a 90-day investment period where we're deploying the cash flow and getting these cash flow assignments. And then there's a 36 month, distribution period where the investor's getting a monthly distribution payment. And then we have what we call a wind down period, which typically can be anywhere from 3 to 12 months. So we've been telling people 4 years.
Got it. And so there's a follow-up question on the local jurisdictions, and this is also something that I think that you guys talked about in terms of when you were talking about operating the fund, that you had some ability to adjust on the fly for operators that are, their business models changing. So if there was some sort of regulatory or other factor that overtook or was compromising the the operator that you had, what kind of things would the operator do, and what kind of things would you do?
You mean the term?
I'll let Derrick take that one. In the event that we have an operator, Derrick, I think the question is what options does the operator and Nectar have if the minimum cash flow payment was subject to a haircut or is impaired or at risk?
And this is specifically due to regulatory constraints, or just?
Well, the question was phrased as kind of pushback, and I think that had to do with the local jurisdiction laws and things like that.
Yeah, so like, ultimately, like, we do our diligence up front on the local jurisdictions and the local laws, and like are focused on places where there's already jurisdiction in place and there's already laws in place. But basically, if there's some reason for us to take a haircut, there's some change that doesn't have to do with the underlying operations, because underlying operations we can take over. Then like we ultimately can say, hey, we expect you to pay $6,000 over 3 years. Or let's say, if you get to the end of that 3-year period, and because of whatever, there was a haircut or jurisdiction, and you still owe us, some amount of money, then we can just extend until we recoup that money back. And that's so we'll get them, and then if they sell the property, then we get paid back out of the proceeds of the sale. As long as any amount above the mortgage payment goes to us to pay us back in full before it goes to the sponsor. So those are the typical ways, just extending and then recouping capital from equity in the sale.
Got it. And one thing that is, again, I'm going to kind of paraphrase a couple of questions here. There's a slide that you had on there that seemed like it had your underwriting points, 9 of them or something like that. How did you guys arrive at that? For just as in terms of anybody interested in this industry, it sounds like you guys arrived at some certain criteria that you thought were most important.
Yeah, I mean, we spent the last several years operating a short-term rental portfolio, underwriting, hundreds of millions of dollars in deal volume for these short-term rental deals and other real estate deals. And we work with just lenders who are lenders in the space, and that's kind of where we came up with our underwriting criteria. We also have a partnership with AirDNA, which is a data company. And they helped us look at, okay, well, if these things happen, how does that play out? And that's really where we came up with, just leveraging our experience in the marketplace.
Gotcha. Okay.
Well, I'd probably just to round that point out, I'd probably add, on the surface, if you're looking at the short-term rental space, you might say, wow, I'd love to own a property on the beach or in the mountains, right? Because that's where people want to vacation. But in reality, what we're underwriting is cash flow. So we are looking at the operator that has a minimum of 3 years of experience, that is a professional, institutional quality operator. They've got controls, they've got systems, they've got financials, they're running a real business. This is not a second income or a sideshow. Number one. Number two, we're looking at the cash flow, and we're looking for stabilized, steady cash flow, right? That's what we want to buy. So things like the site control, meaning, do they have a mortgage? Do they own the property, or are they a property manager, right? Subject to being, replaced with a 30-day notice. So all these types of factors, weigh heavily versus necessarily thinking on the outside, you only care about the location. Because you could have, and you do have, if you look at the AirDNA data, you do have a lot of locations, that, if you looked at it 2 years ago, they might not have popped out and rose to the surface as far as like where people want to be, but these properties are booked, 6 months in advance, and you can look at them relative to the peer set and say, well, this team knows what they're doing, they know how to run these properties,
Right. Okay. Well, listen, we've run over a little bit of time, and I want to be responsive to your guys' time as well as the audience, respectful of that. So there are some additional questions, and most of them revolve around the fund and some particulars about track record and things like that. So I'm going to just say, for those of you who have questions about that, please go ahead and contact Nectar, and hit Andres and Derrick up, and they'll answer your questions. And I appreciate them. But I think, in terms of wrapping up the webinar for today, I just want to thank you guys for coming on. Any parting kind of comments for folks as we head out today?
No, thank you for the time and for bearing through and listening to our presentation here. If you have any interest in the short-term rental market, if you have any interest in investing in real estate cash flows, feel free to reach out directly. We'd love to talk you through how our take on the market, and give you more information on our offering or just the market in general. We love to help people in the ecosystem in general. So thanks for the time. Feel free to reach out directly.
Yeah, thank you, Clay. We've really appreciated being here, and I would echo what Derrick said. Like, we're really built for servicing the needs of the operator community. And if you're interested in the operations and kind of getting into the space or looking at different ways to participate, we're here to be a resource. So thank you, Clay, for the opportunity, and we look forward to partnering. And of course, it goes without saying that if you are interested in investing, we'd love to work with you. And Advanta is set up to work directly with Nectar to facilitate your investment.
Well, thanks again for your time today and for preparing some comments about the industry in general. And I do appreciate you being an ongoing resource for everybody when it comes to that asset class and sharing your expertise. For everybody who joined us today, I hope that this kind of met your educational needs. There will be the session is recorded, and you'll get a link to that via email. We really appreciate you spending some time with us and trusting us with that. And hopefully this was helpful to you. And happy to also, we at Advanta are also happy to be an ongoing resource for you when it comes to IRA investing. So please do feel free to use our educational resources or contact me directly. So thanks, everybody. Have a great day. Be safe, and we'll see you on the next one.